Welcome to the CFO HQ. We hope you enjoy this webinar on FRS 102.
Hello everyone, and welcome to today's webinar on a crucial topic for many of you, FRS 102 and navigating the complexities of the new lease accounting standard that's associated with the new standard in Section 20. I'm Kelly Smith, and I am delighted to introduce our new partner, Finquery. For those of you new to the CFO HQ, we are a leading provider of CFO services, deals, finance, and the tax advisory expertise, assisting businesses of all sizes and industries in finance transformation, managing leadership talent, and finance operations. We also specialize in CFO advisory, sales, exits, due diligence, deal preparation, and execution to drive success for our clients. As many of you know, ensuring compliance with accounting standards like FRS 102 can be a significant undertaking. We at the CFO HQ are committed to providing you with the insights and resources you need to navigate these challenges effectively. That's why we are thrilled to be partnering with Finquery today to drive greater excellence in our compliance tech stack. The new Finquery platform aligns with our objectives to provide deep technology-driven expertise across compliance to simplify the implementation of the lease accounting requires under that Section 20 of FRS 102. Working in partnerships with us, Finquery's understanding of the intricacies of FRS 102 is invaluable. With over 8,000 customers, their lease accounting platform has ensured compliance for accounting and finance teams globally. Today, the Finquery team will walk us through a detailed, practical example of lease transition under FRS 102. This session promises to provide clear, actionable insights that you can apply directly to your own organizations. So, without further ado, please join me in welcoming Rachel Reed from Finquery to begin the presentation. Over to you, Rachel.
Hello, everyone, and welcome to our webinar. Today, we're going to be presenting on FRS 102 and the amendments. And we're going to go through a detailed transition example. So really excited to walk you all through that today. A little bit about who we are as a company. Finquery was actually founded back in 2011 as LeaseQuery, offering the first purpose-built solution for lease accounting. Our mission is to make lives easier by simplifying the complex with technology. Today, we offer accounting automation solutions for both leases as well as prepaids and accruals. And we serve over 8,000 organizations in 93 countries, as well as a large network of more than 250 trusted partners. We are very proud of being the leader in the market, as evidenced by our leader ranking on G2, which is driven wholly by real Finquery customer reviews. And a little bit about me. My name is Rachel Reed. I'm one of the technical accountants here at Finquery. I studied accounting at the University of Mississippi. I did go on to be an auditor at EY, but I've been at Finquery for a long time now in technical accounting, specifically with an emphasis on lease accounting. As for our agenda today, we're going to do a quick introduction of FRS 102 and then go through the comparison between the FRS 102 amendments and the IFRS 16 lease standard. We'll, of course, go through our lease accounting transition example and then talk through the benefits of a software solution compared to Excel for maintaining compliance with FRS 102. So before we talk about the amendments to FRS 102, what is FRS 102? So as a whole, FRS 102 is the comprehensive financial reporting standard, which is applicable to areas that are governed by the FRC. The FRC is the Financial Reporting Council. And FRS 102 as a whole is designed to bring UK GAAP for private entities to be in line with IFRS, or the International Financial Reporting Standards. Now, these FRS guidelines are subject to periodic review, at least every 5 years. And so back in March of 2024, the FRC, again, Financial Reporting Council, who is responsible for the FRS 102 standard, issued some amendments to FRS 102 as part of their periodic review. And these amendments are effective beginning on or after January 1st, 2026, with early adoption permitted. And as a whole, these amendments seek to provide greater consistency and alignment to the international accounting standards. And we're not going to be talking about all of these today. We are specifically going to be talking about the lease portion of this, but I think it's important for you to know that there are a couple areas that were amended. There was a new model for revenue recognition, which is to align with the IFRS 15 standard, revenue from contracts with customers, which we're going to be talking about today, the on-balance sheet lease accounting to align with the IFRS 16 standard for leases. And then some other modifications to things like fair value measurement, uncertain tax positions, business combinations, etc. Now, again, not talking about all of these today, talking about the balance sheet treatment for FRS 102 amendments. Prior to these amendments, operating leases were not reflected on the balance sheet. So when I say on balance sheet lease accounting, that's what I'm referring to now, as lease costs were typically just off the book for operating leases as a rental expense, and they weren't on the balance sheet. But under the revised FRS 102, it mandates that all the in-scope leases, with some exceptions, must be capitalized as a finance lease, and it moves to this single lease model aligning with IFRS 16. Now, who would use FRS 102 versus IFRS 16 versus both? Well, companies in the UK and the Republic of Ireland generally are going to use the FRS 102, while those outside will use IFRS 16. But some companies may have both requirements, particularly those that have UK subsidiaries reporting under FRS 102, but may have a consolidated position under IFRS. So how many businesses are going to be affected? Well, the FRC, again, the Financial Reporting Council, has estimated that roughly 3.4 million businesses are going to be affected by the changes to FRS 102. Now, the FRS 102 lease section, which is section 20, specifically, if you're interested, applies to most leases, but there are some exceptions. And it does include subleases, right-of-use assets in a sublease, but it does not apply to the following leases. So if you have any sort of leases to explore or use natural resources like natural gas, minerals, oil, biological asset leases held within the scope of Section 34, service concession arrangements, again, also within Section 34, licenses for IP, and other rights under licensing agreements, so some intangibles like patents, copyrights, etc. And finally, leases that could lead to a loss to the lessor or the lessee as a result of non-typical contractual terms, which we're going to talk about next. Additionally, a lessee may choose not to apply the requirements, the capitalization requirements, to short-term leases and leases of which the underlying asset is of low value. Now, if you do choose not to apply the requirements to these leases, short-term or low value, you still obviously have to recognize your lease payments and your lease expense, and it's outlined that you can do so on a straight line basis or another systematic basis that's more representative of your benefit from the lease. As we're thinking about short-term leases, something also to consider here is that you can consider short-term leases as of the transition date to FRS 102. So if you have a lease that may be a couple years long, but as of your transition date, it has within 12 months it expires, then that can still be considered a short-term lease. So it doesn't necessarily need to be short-term from the beginning. You can consider the facts and circumstances from your transition date to FRS 102. Now, for low value assets, this is something that has to be evaluated and performed on an absolute basis. And it's interesting because it's regardless of whether the leases are actually material to the lessee. Even further, the actual value of the lease payments has no bearing on whether an underlying asset is considered low value. There are two things that have to be true for an asset to qualify as being low value. The first is that you as the lessee need to be able to benefit from using the asset on its own or together with other resources that are readily available. And the underlying asset isn't dependent or highly dependent on or related with other assets. Now, as far as the examples that the amendments provided, going to be honest, it's pretty inclusive of things that would not be considered low value. So it's going to be a majority of the leases, but I will read them off for you. So if you have leases of cars, vans, buses, trucks, trams, cranes, excavators, loaders, bulldozers, telehandlers, forklifts, tractors, boats, ships, railway rolling stock, aircrafts, aero engines, land, buildings, and production line equipment, those were all very clearly outlined as underlying assets that would not be of low value. So that's going to be, again, quite a few of them. Now, this is not, of course, a comprehensive list, and you will need to use some professional judgment to assess what is considered low value. But effectively, if the asset is something similar to what I just listed off, not going to be considered low value. Additionally, if you sublease the asset or expect to sublease it, the head lease cannot qualify as a low value asset. Now you might be wondering, well, Rachel, you just gave a ton of examples of things that are not low value. What are some examples of things that we could exempt? Well, laptops and other computers, smaller tablets, small items of office furniture, phones. So not a huge list there. So again, don't see a whole lot of leases that are going to be low value, but still something that you need to consider. And then I mentioned leases with non-typical contractual terms. These are exempt not as a whole, but specifically leases that could result in a loss to the lessor or the lessee as a result of how non-typically these contractual terms are written. And again, the standard does provide some examples of things that would not be included in that. So for example, things that are unrelated to changes in the price of the asset, the leased asset, changes in foreign exchange rates or default by one of the counterparties. It was noted that changes in the price of the leased asset is framed pretty widely. So in practice, not that many leases are going to fall within that scope. But again, things with like maybe don't have any payments, there's an undefined lease term, no specified asset, they may have such non-typical contractual terms that they could result in a loss to either party, and in which case are not going to be within scope of Section 20 of the FRS 102 amendments. So we've talked about what is not going to be potentially included, but what actually is considered a lease under FRS 102? Well, luckily they do give us a defined answer. Under the FRS 102 guidance, a contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So we're going to be going through those two highlighted areas in that definition, keeping in mind here that you may assess whether a contract existing at your transition date contains a lease using the facts and circumstances existing as of that date rather than going back. But let's go through some of these areas in that definition. So what is the right to control? Well, the right to control exists for the lessee if they have both of these things. We're going to go through both of these, but the right to obtain substantially all of the economic benefits from using the asset and the ability to direct the asset's use. So you have to, as a tenant or lessee, be able to, throughout the period of use, get the economic benefits either through using the asset directly or indirectly. And this can include a variety of different ways, either by directly using or maybe holding or even subleasing the asset. The economic benefits do include primary output and byproducts. including any potential cash flows, as well as economic benefits otherwise that could be realized. And when assessing the right to obtain the substantially all of the benefits, you have to consider within your own right to use the asset. As far as directing the use, you have the ability to direct the use if either of these things are true. If you have the right to direct how and for what purpose the asset is used throughout the period of use in a manner that reflects and affects the economic benefits derived, or here, you have the ability to direct the relevant decisions about how and for what purpose the asset is used and are predetermined. So basically, if either of those things are true, if you have the ability to direct how and for what purpose it's used, or the decisions are already predetermined. And for this second one, you have the ability to and right to operate the asset throughout the period of use without the supplier having the right to change the operating instructions, or the tenant design the asset in a way that it predetermines how and for what purpose it's going to be used. So if you have the right to control, you may have a lease, but you also need to have an identified asset. An identified asset may be explicitly in a contract or implicitly made available by use in the contract. But even if you do have an asset that's specified, if the supplier has the substantive right to substitute out the asset throughout the period of its use, not going to be considered an identified asset, not going to be considered a lease in scope for FRS 102. Now, how do you evaluate substantive substitution rights? Well, it's based on the facts and circumstances available. You have to exclude things that are probably not likely to occur. And if you cannot readily determine whether your lessor or supplier has substantive substitution right, probably assume that it does not. But both of these things have to be true for a supplier's right to substitute out the asset to be substantive. The supplier or lessor has to have not only the practical ability to substitute out alternative assets, but also we need to benefit economically from doing so. So if they have the ability, the substantive right to substitute the asset out throughout the term of the agreement, just replace it with another asset and would benefit from doing so, not an identified asset. Additionally, you can have portions of an underlying asset that are identified if it's physically distinct. So for example, you may be leasing like a particular floor in a building. If you have a portion of an asset that's not physically distinct, like a certain portion of a fiber optic cable, right? It's not going to be considered an identified asset because it's very difficult to determine like what portion of the benefits you're getting unless that particular fiber optic cable, you're getting substantially all of the capacity of the asset. So again, some judgment needs to be involved as you're determining what is considered an identified asset. But again, keeping in mind that there's no identified asset if your supplier has the substantive right to substitute the asset throughout the term of use. So we've talked through a little bit of an introduction to FRS 102, and you heard me mention IFRS 16 a little bit earlier. So we want to talk through how these standards compare to one another. Both of these standards came about along with ASC 842 for US GAAP, driven by a need for greater transparency and a more accurate representation of companies' financial positions. And both FRS 102 and IFRS 16 have this sort of single lessee lease accounting model, and both aim to achieve similar objectives, but there are some key differences as well as similarities between these two standards. So again, as I mentioned, pre-FRS 102, right, you had operating leases and finance leases. Historically, that's how lease accounting has been, where finance leases were recognized on the balance sheet, operating leases were kept off balance sheet, which just required you to recognize rental or lease expense. And this approach did lead to some concerns about lack of transparency for understating lease liabilities and assets on the balance sheet. So to address the concerns, the IASB had issued IFRS 16, which was effective way back on January 1st of 2019. And that introduced this single accounting model for lessees, which requires you, if you're a lessee, to recognize an ROU or right of use asset, as well as a corresponding lease liability on your balance sheet for all leases except those that are out of scope or exempt from being short term or low value or immaterial. And as we mentioned, following that lead of IFRS 16, the FRC, or Financial Reporting Council, did issue those amendments to update FRS 102 to incorporate the same principle, which again is that single accounting model. And of course, one of the bigger differences between these two standards is the effective date, as the effective date for FRS 102 amendments is January 1st, 2026. You can early adopt if you apply all the amendments at the same time. Again, the specific section for leases in FRS 102 is Section 20. So both FRS 102 and IFRS 16 require you to recognize an ROU asset and a lease liability on your balance sheet for most leases. And both standards require the lease liability to be measured at the present value of the future lease payments. But there are some differences, which we've outlined on the screen here, and we're going to walk through these. The devil's in the details, a little bit more nuanced with some of these differences, but we're going to go through them. One of the bigger differences is the discount rate application options. So when applying IFRS 16 and calculating that initial lease liability, IFRS 16 and FRS 102 actually, but IFRS 16 does require the use of the implicit interest rate if that can be readily determined by the lessee, which it rarely can be readily determinable since it's essentially the lessor's profit margin. So in that case, IFRS 16 does further permit the use of an incremental borrowing rate, IBR, and that is the rate of interest that the lessee would have to pay to borrow over a similar term and with similar security, the funds necessary to obtain an asset of a similar value to the ROU asset in a similar economic environment. So similarly, FRS 102 does also require the use of that lessor's implicit interest rate if it can be readily determined. But again, oftentimes not going to be readily determinable. So it does introduce an additional option outside of the IBR for when that rate is not readily determinable. And that is called the obtainable borrowing rate, or OBR. And you can see here there's some nuanced comparison between the OBR and the IBR. Again, the IBR here is the rate you would have to pay to borrow over a similar term, the funds necessary to obtain an asset of similar to the value of the right of use asset. The OBR, as opposed to the IBR, is going to be easier to obtain, hence obtainable borrowing rate being the name. It's the rate of interest that the lessee would have to pay to borrow over a similar term, an amount similar to the total undiscounted value of the lease payments to be included in the measurement of the lease liability. So again, going to be much easier to obtain because that rate is solely dependent on the value of the lease payments and lease terms, which are readily available inputs just in the lease contract itself. As a lessee, you may do one or more of the following, applying on a lease by lease basis. You may just apply an individual OBR to each individual lease, but you also may apply a single discount rate to a portfolio of leases. So you can use the portfolio approach for those leases that have reasonably similar characteristics. So similar assets of a similar term. So maybe you have, a group of vehicle leases that are, with the same vendor, similar terms. You could potentially use a single discount rate to make that application and obtaining the discount rate even easier on you. Okay, so back to our comparison. While we're talking about discount rates, there are also some differences in discount rate applications during a lease modification. And a lease modification is going to be an amendment or change throughout the lease term. There's a ton of different examples of lease modifications, but under IFRS 16, Lessee has to use an update or an updated discount rate. So they have to revise and reobtain essentially their discount rate for all these modifications that aren't considered new leases. Sometimes the terms of a lease modification are so drastically different and they change the scope so much from the original lease that it has to be accounted for as a separate lease. But under IFRS, all these modifications that aren't considered new leases, you have to reassess that discount rate. Now, generally, same concept applies to FRS 102. However, to make things a little bit easier, there are some scenarios that were introduced in Section 20 for leases that allow a lessee not to update the discount rate. And there's actually three that are going to be pretty inclusive of a lot of the changes that you might have in a typical renegotiation. The first is if within the lease modification, the additional consideration or payment from the change in the lease is insignificant relative to the total. So, you have to pay a little bit more, but it's insignificant relative to the total amount of the original lease. Second scenario is if the modification reduces or decreases the scope of the lease by removing a portion or a right to use a portion of the underlying assets. So, you're reducing the amount of space in a building or reducing the piece of equipment on a particular lease. And if the payment or consideration for the lease decreases by an amount comparable or in proportion with the standalone price for the decrease, you don't have to reassess the discount rate at that time. And third, if the modification decreases the payments or the consideration payable for the remaining term, but doesn't decrease the scope by removing one or more of the underlying assets and the right to use them. So if you renegotiate and you get a lower rate, but you're not paying for less of the asset, you just renegotiate a lower rate. So you don't need to change your discount rate if any of those three scenarios apply, but if you do use an unchanged discount rate for a lease modification, you do need to include that in your disclosures. All right. What about some nuances with low value assets and also the maturity analysis for low value assets? There are some nuanced differences here. So under IFRS 16, if you're a lessee, you may have chosen to take advantage of an optional exemption that was for low value assets. And it was actually explicitly defined within the basis for conclusions as leases for which the underlying assets fair value when it's new is generally less than $5,000. Now, difference here is that FRS 102 does not provide guidance around a specific dollar threshold, but as we saw, there's some specifics that need to be met. There is some flexibility in judgment that's going to be required to determine whether you have assets that are low value. But unlike IFRS 16, FRS 102 amendments does require for lessees to disclose a maturity analysis of exempted leases related to short-term or low value. So for IFRS 16, you did not need to disclose a maturity analysis showing, the future maturities for lease commitments, but FRS 102 does require that specifically within its disclosure requirements. Finally here, the transition method differs slightly between IFRS 16 and FRS 102. Similar in that there's a modified retrospective option for IFRS 16, but IFRS 16 did provide a choice of that modified retrospective approach or a full retrospective approach. Full retrospective being more complex, requiring more work. Under FRS 102, there's no full retrospective approach for leases. It's just simply a modified retrospective approach, which will ultimately simplify the transition for companies. Additionally, if you are one of the organizations who had to implement IFRS 16 for consolidated reporting purposes, but you also have to do FRS 102, if you already have those balances for your group or consolidated reporting purposes, To make this even easier, you're allowed to use those carrying values as your opening values for your FRS 102 application for the right of use asset and lease liability. It states specifically any lessee applying IFRS 16 may use that lease liability and right of use asset calculated under IFRS as a date of transition. But if you do make this election, which this should make it easier, you need to disclose that, but also make sure you're applying it to all of your leases. So you can't pick and choose the ones that may be more beneficial for your balance sheet. If you are going to be using those balances from IFRS 16 as your opening balances, you need to do it to all leases and disclose that. That should make it easier for those organizations who have to do both, is that you can utilize your existing balances. All right, so before we just jump into our example here, want to talk through how you would actually measure this lease liability that you have to have on your books and the right of use asset. Now, again, we're considering those that are not also applying that IFRS 16 election, because again, if you are applying that IFRS 16 election, you can use your carrying value, but if you have to initially measure and you haven't implemented IFRS 16, you don't have a lease liability and asset on your books, this is how you do so. So you would measure that lease liability first before the asset at the date of your adoption or transition to the FRS 102 amendments at the present value, current value of the remaining lease payments. So the lease payments remaining from your transition date on, not considering things prior, and discounted using the IBR, incremental borrowing rate, or as we talked about, that obtainable borrowing rate. That rate, though, is as of your transition date to FRS, not as of the start of the lease, but as of the transition. What is the obtainable borrowing rate? So first you recognize that, and then you recognize the right of use asset based on that value, that lease liability value, with some adjustments for things like prepayments. So, any prepayments would increase it. Any incentives received, initial direct costs. If you have within Section 21, there's specific guidance around this, like dismantling or removal costs to restore the underlying asset to the condition required by the terms and conditions of the lease. If you do have a lease where a lease component contains like a government grant, any amount within Section 24 for a public benefit entity. So there's some nuances within this right of use asset, but generally it's going to be equal to the value of the lease liability plus or minus any existing balances you may already have as of your transition date. For things like deferred rent, prepaid rent, that liability, which is going to ultimately drive the value of the right of use asset. I mentioned, the present value of the lease payments. But what lease payments are included? So it's fixed payments, which is going to be, your contracted payments. Even if you have payments that, increase year over year by a stated amount of percentage, that's still considered fixed if it's written into the contract and able to be present value based on the fact that it's fixed in nature. But also it includes in substance fixed payments, which are a little bit tricky to identify, but they may appear as variable payments, but they're fixed. An example would be if you have a lease that offers, a sort of a choice for payments, either being variable based on amount of sales, which may be the case for some of you in, the retail space, based on percentage of sales you have to pay, and obviously that sales is variable, but the other amount being a required minimum. So while that sales amount is variable, it can't be calculated until your sales are known, that minimum required payment, so at minimum you're going to be paying a base amount, that's considered in substance fixed. Therefore, that needs to be included in the lease liability. It does also include variable payments that are dependent on an index or rate. So if you have CPI increases built in, those will be measured as of the index or rate as of the commencement. And then any expected amount that you are expecting to pay under a residual value guarantee. if applicable. So if there's, a difference between the expected residual value and the guaranteed residual value, that amount that you're expecting to owe would be included. The price of a purchase option and exercising that purchase option if you are reasonably certain to exercise that option. And any sort of termination penalties, again, these are all if applicable, right? So if you have a penalty for like early terminating the lease and your term reflects that option to terminate, you already know you're going to terminate it, that penalty should be included in your liability because it's ultimately going to be an obligation to you. So that's how you measure the lease liability and the right of use asset. Knowing that information, we're going to apply that to an example scenario here. We're not going to include all of those different types of payments, but this is a pretty common example of just a standard real estate lease that is current and then needs to transition over. So let's read our scenario first. So we're going to assume here that we're the lessee, and we signed and entered a lease agreement that stipulated that starting on January 1st of 2025, this year, we're leasing an office space for 5 years, 60 months. Within the contracted terms, we have to pay £1,000 every month on the first of the month. And written into the contract is a £500 increase on January 1st of every year. So just right off the bat, the way that that's written, that increase is going to be included as a fixed payment. So it's based on something known, it's pre-negotiated, £500, that's going to be included in our lease payments. We went ahead and assessed that as of our transition date, we're looking in the future here, which is January 1st, 2026, our obtainable borrowing rate is 6.25%. So not assuming anything else here, the first thing that you would actually do, which we're not going to show, but I will explain, is you need to account for the lease this year, right? It started on January 1st. So what would you do? You create your payment schedule and you would calculate your straight line expense. So if you do the math and you do, $1,000 increasing by 500 every year, $1,000, 1,500 or pounds, 1,500, 2,000, etc. Your total value of your lease payments needs to be calculated. So if you add all those up, it becomes 120,000 pounds. To calculate the straight line expense, you just divide that over the periods, which is 60 for 5 years, and you have a 2,000 pound straight line expense. So this is how you would be accounting for this lease prior to transition to FRS 102. So on a monthly basis, in that first year, you're paying 1,000 pounds, but your straight line cost is 2,000 pounds. So each month you would be accruing a 1,000 pound deferred rent, which at the end is going to be 12,000 pounds. So it's 1,000 times 12. So we're assuming that you've been accounting for this lease correctly. And as of December 31st of 2025, you have a deferred rent or accrued deferred rent balance of 12,000 pounds based on that difference throughout the year. So that's our scenario. What do we do first? Well, the first thing you would do, as we outlined, is calculate your lease liability. And that lease liability is going to be based on the present value of the lease payments. And we're going to use that 6.25%. So you don't take the lease payments from the beginning of the lease, you take them from the transition date. So we've got 48 months worth of our lease term remaining. And as of that date, it's actually 1,500 pounds. So you take the present value of that payment schedule. And if you're wondering how I did this or you don't believe me, you can put it into a PV calculator, a PV tool. We actually have a tool, which I'll show you in the next slide. But you use that remaining term and payments to calculate the current or present value from transition using that obtainable borrowing rate. In our particular case, it is 94,179 pounds. Again, I plugged this into our present value calculator tool. You may have your own or some sort of a PV calc, but again, our payments were made at the beginning of each period. Our periods are in months. Our annual OBR is 6.25%, and we've got our 48 periods. So if you plug that in, 94,179 is your starting liability. Well, that's not all. Of course, if you're recognizing your lease liability, you also have to recognize that right-of-use asset. There were no other facts or circumstances that would have other adjustments to our right-of-use asset outside of the fact that we have been accounting for this lease for a year and have an accrued deferred balance of 12,000 pounds. So based on our liability calculation, which was 94,179, we subtract out our accrued deferred balance, which is as of December 31st, 2025, and we have an initial measurement for our right-of-use asset of 82,179 pounds. Here's where it gets a little bit tricky. So you have to use that information to create essentially a finance lease amortization schedule. So we'll walk through how to set this up. But the first thing that you would want to do is set up your table with your liability and your asset sign and the appropriate columns. You've got your cash, interest, principal reduction, liability. You would need a short-term, long-term split. We're not showing that here today. Your asset, depreciation, and gross asset balance. So starting with your first balances, as of 1/1 of 2026, we had a lease liability of 94,179 pounds. That goes into our starting line. And then subsequently, we have that right-of-use asset. Now, I like to do the asset side first, just because it's a little bit easier of a calculation. So what would you do with that asset? Well, the right-of-use asset has to be depreciated over the shorter of the useful life or lease term. And as we look at our depreciation here, we're going to take that 82,179 pounds and take that over the remaining life, which is 48 months. That will calculate our straight line depreciation. So you take that 82,179, recognize depreciation, and each period subsequently, that will reduce that net asset balance until it is zero. Now you may be wondering, Rachel, it's not zero. Well, we can only fit 1 year here on the screen, but you would make this go all the way out till the end of the lease term. And trust me when I say that when it goes all the way down, it does equal zero. And then you take that depreciation, and that goes into your accumulated depreciation account, which is the sum of depreciation each period. And you've got your gross asset on the right, which wouldn't change unless there was a modification. So we already have 4 of these columns done. The left-hand side here is the lease liability section. Starting with your 94,179, each period we're going to be making a 1,500 pound payment, and then next year it goes up to 2,000 pounds. But how you calculate these columns is you take and input the cash, and the interest expense is going to be based on the outstanding lease liability and the number of days that that liability is outstanding. So you would take your 6.25% multiplied by your liability to get your interest expense, if doing so just on a monthly basis. That difference between the cash and the interest becomes the principal reduction, and similarly the asset, by the end of the lease term, you will have paid off your lease liability as you no longer have an obligation to make payments. So at the end, it will be zero. So you need to create one of these amortization schedules for each of those existing leases. And if you already have finance leases, this should look familiar. Or again, if you're already using the IFRS 16 balances, you can use those carrying values, but you still need to have an amortization schedule using those carrying values rather than just recognizing them as we did at the present value at transition. So you go ahead and create that amortization schedule, and then you have to, of course, recognize journal entries. The right-of-use asset and liability entry is up at the top to convert and establish your opening balances. You clear out that accrued deferred rent we talked about, which was 12,000 pounds with a debit. You establish that asset balance with the debit and credit that lease liability to increase it. Each period subsequently, you need to recognize interest and depreciation. Depreciation is 1,712 based on our right-of-use asset depreciation calculation. And then you'll have a debit for interest expense, a credit for that cash payment, and the difference will go to reducing that lease liability in each period. And we're going to finish up with our final section today, which is going to be talking about how software can assist you with FRS 102 compliance and how it may compare to those Excel or spreadsheets that you may be using today. So one of the biggest areas that a software can compare to an Excel spreadsheet for assisting with the initial transition to FRS 102, but also ongoing compliance, is the separation of duties that a software will have. So with Excel, there's no way to really review and separate out who can do what. And a software will allow you to set up internal controls, which would include having one person who edits data, another person who approves it. In Excel, there's no way to approve information. What's changed is changed, and it can potentially impact your amortization schedules and calculations. And there's no check on that. If somebody accidentally puts in the wrong value or messes up a formula, there's no review. It's just immediately live. And a software will allow for that separation of duties and internal controls. So you can actually see what may be in your queue. And as you can see here, this is just an example of what this may look like. You can see any sort of changes that need to be approved or things that need to be completed and who is responsible for it. Additionally, with having all of your lease information within Excel spreadsheets for FRS 102 compliance, you lose out on the ability to be proactive with changes or renegotiations or dates. You're often very reactive in Excel because you're not finding out about things until after they already happen. So having a software for separation of duties and actions required and even critical date reminders will let you know when leases are expiring and prompt you to renegotiate or let it lapse. And you have enough time to make decisions about those things rather than hearing about them and having to make retroactive adjustments to your Excel spreadsheets because maybe it wasn't communicated to you timely. So again, in Excel, you are manually enforcing these different controls. With software, you have the option to separate out different duties and provide access to different people based on what they may need to be able to do in the tool, whether that's audit view access, data entry, reviewers, and you have that peace of mind of knowing that information can't be changed unless you have that approval. Additionally, with Excel, if somebody does make changes, you have to really dig in to find them. There's no visibility to those changes. And a software would provide an audit trail for any changes made, not only for you to know what's going on with your lease portfolio, but for your auditors to have access to audit history reports to see what changes may impact your amortization schedules and your balances. Additionally, with Excel, you have to make those calculations from scratch. And it's based on your understanding of the guidance. So while it's my job to be an expert in lease accounting, I know that you're busy. You've got a lot of other things going on, and there's a ton of guidance and nuances that you need to be aware of in order to be compliant with FRS 102. So a software has those things built in. It's based and built by accountants with amortization schedules and journal entries automatically calculated, rather than you having to go in and create those schedules as we did and showed today. Additionally, Excel doesn't provide a document repository. You may have documentation for leases all over the place. It may be siloed internally. Maybe certain people have it in a shared drive. Some people have a physical PDF printed out. There's typically a lot of different places where documents are held, and a software allows all of that to come together for quick access for important business decisions, as well as for audit preparation. When the auditors are looking to do their testing and go back to the source documents, if you're using Excel, there's not a great way to aggregate that, and you have to use like a shared drive or something like that to give them access to. Document repository within a software will alleviate that concern for FRS 102 initial lease gathering and compliance, but ongoing with any changes. And finally, all of this increases your collaboration, as there are a ton of different departments that may be working on and have their hands on leases, like legal negotiating them, accounts payable paying them, real estate who may be sourcing and finding these new locations, IT who may be managing some of these technology leases, accounting who obviously has to account for them, treasury finding these obtainable discount rates, So with a software that you can provide unlimited user access to, everyone will have access to the same information all in one place, and it improves the workflow with that internal control and approval process and just general communication around the process around your leases. All right, so that does conclude today's presentation. Thank you for joining us. If you have any questions, you can send them now by clicking the Q&A icon at the bottom of the screen. You can email us at cpeinfo@finquery.com. But once again, thank you all for joining today's webinar.